Welcome to Bloomberg ETF IQ. I'm Sonali Basak in for Katie Greifeld.
And I'm Matt Miller. A lot going on today with potential IPOs, some M&A. It's pretty risk on.
It's pretty risk on, but not everywhere. We're going to talk about where exactly people are taking on risk today.
Yeah, let's take a look right now at the more than $10 trillion global ETF industry. In just a few moments, we're going to speak with Steve Laipply, global co-head of iShares Fixed Income ETFs at BlackRock, to discuss where exactly he sees opportunity in his markets.
And despite a surprise rally in the S&P 500, in terms of a downfall, investors are still hedging their bets. We are going to talk about those hedging costs, especially when it comes to the SPY, Matt.
And from a blog in 2005 to an ETF in 2023, we'll look at an equity fund unlike any other that doesn't even do any trading.
And Matt, we're always going to talk to Eric Balchunas first with Bloomberg Intelligence. He's back with us, and he is looking at the flows.
Thank you, Sonali and Matt. And yes, the hedging cost is very apropos because we're sort of seeing this in the flows, right? A little bit of tension in the flows, tug of war. Yes, SPY is at the top, and you like to see that, and VU as well. But you look a little further down, you're getting S-Gov rate, a little bit more return into treasuries. I want to go into that in a minute as well. But also Q-Tech is interesting. That's a ETF that's only the tech side of the Qs, and it happens to be outperforming the Qs this year. Not much is, it's up 40%, but interesting trade into the Qs. So let's go look at the outflows. And this is where the real Qs, is getting hit hard. $3.3 billion. Again, you hate to see it if you're looking for bullish sentiment. And also you can see money coming out of LQD and HYG. And let's take a minute, though. These flows aren't everything. There's also the mutual fund world. And I want to look at money market mutual funds because they also, I think, talk about this idea of people maybe taking money off the table. Look at the assets in money market mutual funds, up to $5.6 trillion. Kind of took a little break during the summer when everybody was in equities, but people are coming back in. $138 billion in the past 6 weeks going here, and $1 trillion over the past year. That is 9 times what all fixed income ETFs have taken in. 9 times, Matt. That is a lot of money. It makes this fixed income, the money into treasuries, look very small. And again, 5% yield, dollar NAV. It's a big-time value proposition for investors right now.
All right. Thank you very much, Eric. Let's talk about that right now with Steve Laipply. He's global co-head of iShares Fixed Income ETFs at BlackRock. And Steve, let me first get your comments on money market funds. I mean, I've been watching this index more closely this year than I have any other in the 23 years I've been here. What do you think of the massive pile of money in money market funds?
Yeah, I think it's a reflection of investors not really knowing what to do at this point. So obviously, equity markets have rallied. We've had some reprieve from last year's red across the board, but I think investors are still fairly uneasy about what the Fed's doing and what direction inflation will ultimately settle in. So you're seeing a lot of cash on the sideline. We're seeing this in our flows as well. So this year we've taken in around $13 billion in the very short end of the Treasury curve, into about half of that in S-Gov and about half of that in T-Flow. And there's just this real appetite for safety at the moment, especially when you can get north of 5% at that front end of the curve, whether you're in Treasuries or prime money markets, et cetera.
How volatile are the flows? To what extent is this a lot of using the ETFs to hedge current positions versus long-term plays?
Well, Sonali, I think it depends on what sector you're looking at. We've seen pretty volatile flows in credit, particularly in the larger, more liquid funds like LQD and HYG. So there's been a fair amount of flow volatility. I mean, net, you're seeing outflows in those credit risky sectors. But interestingly, in treasuries, you've seen positive inflows. Yes, there's some whippiness around TLT, but it's still up 15 billion year to date. And so where you're seeing flows more sticky will tend to be the higher quality exposures like treasuries, multi-sector like ag. We've taken in over 11 billion into that fund, about 3.5 billion into universal. So you are seeing investors putting money to work in these higher quality exposures and sort of staying with it.
Steve, if you're a trader and you're looking to trade this in your retail investor, what's the move here to sort of try to find your opportunities, or just dump it all in IUSB or AGG and just sort of let that do the work and reflect the changing market?
I think that's one approach. So it is very, very hard to time the top in rates. It's extremely difficult because, as you've seen this year, we were bouncing around sort of the high threes in the 10-year, and then in August we marched upwards of 4.25. Now we're pushing 4.30 again. So it's hard to time the top in rates, and I think investors are better served by picking, a broad allocation where they want to put money to work in fixed income. You are seeing a generational opportunity in yields. You have to go all the way back over a decade or more to see the type of yield that you're seeing now across the market, whether that's in the front end or more broadly. So I think it is important to reallocate to fixed income. You could allocate to AGG or IUSD, or if you wanted to allocate in an active context, we have launched an active fund, BINC, with Rick Reeder's team. That fund has outperformed both Ag and Universal since its inception. So that's another direction you could go as well.
I've been hearing a lot of people saying that they're not getting as much return as they need to compensate for the risk in high yield. And I know you have some products there. BuyRight is the brand name that you've got for some of them. Tell us about that, and why do you think we're not seeing wide enough spreads to attract investors in retail when we are seeing such incredible inflows into some of your BuyRight products?
Yeah, so Matt, going back to high yield, if you look at long-term spread averages, we are inside of the 5 and 10-year average. It's around 400 basis points right now. If you look at Bloomberg's high yield index, you're around 375 over Treasury. So it is inside of that longer-term average. I think investors are still looking for yield, but they're a little bit wary of going down in credit. So I think that explains a lot of the flows we've seen in BuyRights, because in particular the Treasury product TLTW has seen some pretty enormous flows year to date. That fund is now sitting over $700 million. Its trailing yield is in the high teens, and even now its current yield is still in the low teens. So that fund has outperformed 20 plus treasuries, TLT itself, by over 7% year to date. So that gives you a feel for what that extra income can do for you in a sideways market, or if rates are rising, it can help cushion some of that downside if rates are actually going up, like what we saw in August.
Yeah, and Steve, the BuyRight concept is sweeping over the equity market too. JEPI was a huge hit. But can you just take a second and just, what are you giving up here? I mean, you get the 12 to 16% yield here. What do you have to forego? What's the risk if you're an investor?
Yeah, that's right, Eric. So in exchange for this income, there is a cost, and that cost is you are giving up potential upside. So if you believe that we could be heading into a slowdown, going into next year, and you want to own duration, by using a BuyRight strategy, you're going to give up the benefit of that duration. In other words, if rates rally from here due to a slowdown, due to some risk-off event, you are giving that up. You're giving it up deliberately in exchange for higher income. So you have to make that call. Do you believe in sort of higher for longer, or are you a little bit more worried about things turning here going into the end of the year, beginning of next year?
Speaking of things turning, at what point do things like HYG, J&K start to feel the love? Is it worth really taking on credit risk at this point, given how uncertain the macro is?
Yeah, I think that's a great question. And again, so far in terms of ETF flows, investors appear to have been very hesitant to go into high yield. What's strange about that is that the returns this year have actually been pretty decent. So, you've returned, I think, upwards of 7%. All-in yields are, around 8.5% on high yield. So again, the long-term spread averages are snug compared to where they've been over time. And so I think that's what's giving investors pause. One way to play it, there are products out there that are more defensive in nature in terms of high yield. We have, for example, a high yield defensive bond product, HYDB, which has tended to perform pretty well over time, but it's meant to deal with a downward turn in the credit cycle. And so that's a way to play it if you're worried about things turning south and getting into more of a negative credit cycle here as we head into next year, and if you believe growth is going to slow.
Steve, great to talk to you today. Thanks so much for joining us. Steve Laipply there of BlackRock, talking to us about the fixed income industry that he covers there, as well as really the economy. I guess that's how the questions, they're going to always be interrelated. Coming up, the S&P 500 surprise rally is rewarding traders who bought in early, but fears of a downturn still persist, including a bet against one of the largest ETFs of all time, SPY. This is ETF IQ on Bloomberg.
Welcome back to ETF IQ. It's time now for the ETF Brief, where I highlight one story and trend, or three stories and trends that caught my eye. I want to start with BRNT. This is the Wisdom Tree Brent Oil ETF, because if you look, it has had the largest outflow on record. That is $500 million pulled out of the Brent ETF after you had Brent oil surpass $90. You're still looking at Brent on the rise, still at its highest levels since November, the highest levels all year. I also want to take a look here at the EM world, because you're looking at a lot of choppy economic data coming out of China, and you're watching the iShares emerging markets ETF ex-China just rise at a much faster rate in assets than you are seeing for the rest of the universe that does involve China. That differential has just gotten wider throughout the year. And lastly, I want to talk about the appetite for hedging the stock market, because even though you've seen the S&P largely on the rise this year, some volatile sessions, some choppy sessions has shot up the cost of hedging against a 10% drop in the SPY ETF. And that cost has just picked up in September. Matt.
Appetite for protection.
Need protection.
You know, it reminds me of the famous Guns N' Roses record.
I went to their concert last week, so it makes sense. I'm talking about it now.
Sonali Basak here with me. Let's talk about this issue with Bloomberg's Jess Menton, and we'll kick it off with the potential of destruction here. Why is there such a worry that this stock market is going to suddenly tank when we're so far above where we thought we would be at year end already?
And so many traders have gotten burned trying to hedge this year, especially when you look at double-digit rallies in the S&P 500 as well as the NASDAQ 100. But you still have a lot of people just skeptical in general about the economy. But clearly we've seen the data continue to be resilient. But you've seen some of that hedging start to pick up again this month. Not surprisingly, we do have the CPI report later this week on Wednesday. And then, of course, we have the Fed decision on September 20th. But if you're a bull and you looked at this could potentially be more of a bullish indicator for them, because if you're on that side of the coin, you would want people to still be a little bit more fearful, because then you don't have everybody all of a sudden the pendulum swinging to people are too optimistic about the rally. So that's something that's been a little bit interesting when I'm speaking with strategists.
Yeah, and I'm curious as where else you're seeing this view reflected. Not so much that bullish view, but that cautious view that we're seeing in the hedging. How is this reflected through the ETFs when it comes to the growth world?
Right, so that's a great question. And when you're looking at more broadly with the hedging and some of these, sometimes it's a little bit harder to gauge. So this particular metric I was taking a look at, along with Carly Wana on our U.S. equities team, it's more 1 month implied volatility. When you're looking further out, it's a bit harder to gauge, just because when you think of the zero options and more, when things come to maturity within 24 hours for the S&P 500, you're not seeing it quite as much in the longer term gauges, just because people are trading a little bit more quickly. And then, of course, if you were going into Labor Day weekend, you might not want to hold on to particular option buyers with certain puts like that. They may not have held that, but then coming into this month, they may have gotten that again, just because you do have, obviously, the CPI report and then the Fed decision. But really, when you're thinking about September, Goldman Sachs actually was mentioning there's actually more than 50 investor days this month. So typically they were actually saying they're neutral on selling put options, just because they think that volatility would pick up beyond even when we're talking about like CPI or the Fed decision.
By the way, we were talking with Jessica Rabe earlier from Data Trek, and she mentioned something I thought was interesting. They have recommendations towards you when the VIX hits 24, 36, or 48, which is like, we're so far away from that. Does the VIX work in any way to tell you when volatility is going to pick up, or does the VIX only show you when you're already in kind of the eye of the storm?
So Chris Murphy from Susquehanna, I was speaking to him about this last week, writing this story that we put over the weekend. And for him, he still thinks that when you're looking at the VIX, it's probably going to maintain below 20, because once it gets closer to that level, there's certain things in the options market that people are betting on, and then it prevents it from continuing to move above that. So in his mind, he's kind of skeptical that we'd actually see a big move unless there's some sort of outsized events that could really drive that further.
Our thanks to Bloomberg's Jess Menton. Still ahead, we're going to drill down into the equities market with Ed Elfenbein of AdvisorShares up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Sonali Basak today.
And with us is Eric Balchunas from Bloomberg Intelligence. He's back with today's drill down where we focus on just one ETF. Eric.
Sonali, today we look at CWS. Stands for Crossing Wall Street, which is a blog, stock picking blog that was converted or still exists, but is now an ETF based on it. As you can see, it's actively managed. It's a very concentrated portfolio, 25 stocks. Tends to look at quality and value, uses fundamentals. So it tilts a little more towards the mid cap or smaller large caps. $73 million in assets, pretty good for an active fund. Expense ratio 75, but that's a fulcrum fee. If they outperform, they take a little bonus. If they underperform, you get it's a little bit of a less of a fee. Let's look at the holdings here. You can see this isn't your typical active fund that's loaded with like Amazon and Apple. You can see just by looking at these stocks, you're going to know some of these names, but as you can see, these are going to be a little less. So this thing has an average market cap that's much less than the S&P and a slightly lower price to earnings ratio. Let's look at the performance of this versus the S&P, which is his benchmark. But I threw in mid caps because, again, this thing does tilt down a little bit. And you can see it's up 123% since its inception, slightly underperforming the S&P, but blowing away mid caps. So this thing, it's going to outperform when the Super 7 or these mega caps take a break. So if you see that coming, this ETF is probably in a good position to have some outperformance, which again should draw more looks.
Thank you, Eric. And joining us to talk about this ETF is Edward Elfenbein. He's the portfolio manager at AdvisorShares Investments. What are you looking at when you are...
Or looking at.
when you were thinking about the direction of this market and what can outperform in the world that you're in?
Right now, I mean, what we're looking at, it looks like the Fed is going to pause next week. Maybe it's about 50-50 we'll get a rate hike coming in November. But I think right now there's been a concern that if we're going to cut rates right now, the Federal Reserve is going to bring us right back to the playbook of 2020 and 2021. So back then we see Zoom and Moderna, and now that's being replaced by the Super 7 and the intelligence, all of that kind of stocks. That's just going to replace that. We're going right back to that. I think the market is assuming too much. And I'm looking at a lot of these high quality, low beta names that I think look very good right now.
So what, I mean, I guess I could say Trexco is your favorite, but what do I take as your favorite considering all the names that we just saw there?
Well, I'll tell you one that you might like, which is Miller Industries. And this is a wonderful company. It's not followed by a single Wall Street analyst. I love this. It's a tow truck company based in Chattanooga, Tennessee.
Nice.
It's a wonderful little company, and they just had a blowout earnings report. And I can't say if it beat expectations or not because no one follows it.
So there were no expectations.
There were no expectations.
That we know
of. I was looking through your holdings historically just to see what you're buying and selling, and I did see the move to industrials. One stock you sold out of, I mean, this is like a perfect trade. You had Disney for many years. It crushed it. You sold it exactly 2 years ago. Since then, down 56%. What alarmed you? What got you to get out of that company at that time?
I got to tell you, that was a really difficult one because it was a company I had a strong conviction in. But I really didn't like the culture that I saw forming at Disney. I don't like when companies treat their customers, particularly their core customers, like an ATM. And I got that feeling that's how Disney was behaving. Very high prices across the board. And that, of course, there was a leadership change. So that made me make the decision to pull the plug on Disney.
But that's the farthest thing from an orphan stock that there is.
That is true.
I mean, Miller Industries and Disney are like two ends of the spectrum, right? Because everybody on the street follows Disney. No one follows Miller. Does that matter to you?
Not at all. I go wherever there's a bargain.
Now, if you're taking a look and you think that there is either a soft landing or a harder recession, what would you trade out of today that you are still in if you think things were going to get worse than the market currently thinks it is?
I mean, the obvious choice is a lot of these Super 7 stocks. They really have run so far. Even if you don't have to exit your position, it's a good time to take profits on those. That's the #1 concern I would have.
Just a little bit about positioning this fund in a portfolio. We do a lot of work on how active should move forward, and you're concentrated, which I think is a viable lane, because you can complement cheap beta rather than competing with it. How do you position this to advisors? Are they looking for performance mainly, or does that active share, which is 96% in your case, does that matter to them because it could be used as a satellite position?
I think that really just like the concept of it, the idea that we don't do any trading, no trades are made during the entire year. We focus on just the high quality names, and we stick with them. We only trade. We have a 20% turnover each year, so 5 of the 25, 5 go in, 5 new ones come in, 5 go out.
You have this fulcrum fee that Eric was talking about. I'd never heard of it before now, and I don't think it's widely used in the industry. How has that worked out for you and for your investors?
I think it's been great personally because I've been getting a nice bonus, so that's good. That's good. We believe we were the first ones in the ETF space to use that. It does exist in the open-end community. I don't know if any others have used it, but I think it's a great way to say to investors, we are aligning with your interests. We have skin in the game. And I think it's a way that Wall Street will be moving towards those sorts of qualities.
Double down on that, because on one hand, ETFs have brought down the fee structure for the investing universe to begin with, but with all of these new actively managed ETFs, that is getting a little more expensive. Do you think that this fulcrum idea might take more steam with those higher fees that we're starting to see?
I certainly hope so, because one of the problems is a lot of these smaller ETF shops, I'm afraid, are getting pushed out. So we turn 7 years old next week. I don't know if our kind of fund could launch in this type of atmosphere. Maybe we got in at the right time. But I think things like the fulcrum fee and the tax efficiency, I think these are going to gain steam and become larger as the years go on.
All right, fascinating story. Really glad to get you in here, Eddie. Thanks so much for joining us. Eddie Elfenbein there of AdvisorShares. His ETF turned 7, CWS, as he said. If you just can't get enough of ETFs, a reminder that you can listen to Eric with Joel Weber, our editor of Business Week, on Trillions. That's their bi-weekly podcast that covers the industry and fascinating stories like CWS and Eddie as well. Also, I recommend following Eddie on Twitter because he says some stuff that just sticks with you. I think about you in bed a lot because you once tweeted that it's too hot when the covers, both legs are under the covers. It's too cold when both your legs are out of the covers, but you need one under and one over in order to. That's to me makes a lot of sense. That does it for Bloomberg ETF IQ. I'm Matt Miller along with Eric Balchunas and Sonali Basak. This is Bloomberg.